Rolls-Royce just reported a record first half year. They raised their full year guidance by £700 million. Shares hit an all-time high. You'd expect the second half to be even bigger. It isn't. Take the number they just raised the guidance to and subtract the $2.5 billion they already earned. What's left for the second half is less than the first half made. So let's go through exactly what was in this half that isn't coming back, how this is different from the last few years, and what it means for your investments. In 2021, Rolls-Royce made less than £4 of operating profit on every £100 of revenue. That's an operating margin of only 3.8%. Back then, the company was also carrying $5 billion in net debt. This half, the margin was 22.5%, 6 times as much as in 2021, and the company has $2.1 billion of net cash. And for the first time in a decade, essentially no aircraft are parked and waiting on engines, which was the problem that defined this company's reputation for most of the last 10 years. The new CEO, and please excuse my pronunciation, Tufan Erginbilgic, took over at the start of 2023 and pulled off this recovery. He is also the one who gave the latest midterm target, $4.9 billion to $5.2 billion in operating profit to be delivered by 2028. Now, last Thursday, Rolls-Royce reported their results for the first half of 2026 and upgraded their guidance to £4.7 to £4.9 billion for this year. That's the 2028 plan, landing 2 years early. My own stock rating model puts the quality of this business at 7.4 out of 10. Wide moat and no customer concentration risk worth the name. So nothing that I'll talk about is an argument with the turnaround. The turnaround is real, it's in the numbers. And anyone telling you otherwise hasn't read the release. What I want to show you is what happened underneath it. Because back in February, Rolls-Royce still showed an operating profit guidance of $4 billion to $4.2 billion for this year. But last week they raised that by £700 million to $4.7 to $4.9 billion. That's an increase of around 18%. They had a record half with the guidance raised and the stock up by 5.5% on the same day and reaching new all-time highs by today. That's the story everyone talked about. Now let's do the thing that almost nobody did last week. Subtract. Because if we take the higher end of this full year guidance and subtract the $2.534 billion that the company already earned in profits from the first half of this year, the second half is expected to earn $2.166 billion. This is quite a bit less than they already earned in the first half. And the same is true when we look at the lower end of the guidance. So the management raised the full year number by £700 million and the number they raised it to still says that the second half of this year earns less than the first half. That isn't the normal shape of this business. In 2024, Rolls-Royce made $1.1 billion in the first half and $1.3 billion in the second. The second half was bigger, like most industrials. Last year was pretty close. 1733 against 1729. But this year, for the first time in the last few years, the guidance implies that the second half is actually weaker than the first one was. When we bring the revenue into this, it gets even harder to explain. Rolls-Royce doesn't guide revenue, but its own seasonality is pretty consistent. About 45% in the first half, 55% in the second, for the last 4 years straight. When we apply that to the $11.4 billion just reported, and the second half should turn over something like $13.7 billion. The analyst consensus is even below that at $12.5 billion. But whichever revenue you use, the company's own seasonal behavior or what the Wall Street is modeling, the second half margins land somewhere in the mid to high teens, against the 22.5% of the first half. So more revenue, but less profit. That's a second half operating margin somewhere between 15.8% and 17.3%, against 22.5% in the first. So there is quite a big difference in the margin, and the expected margin for the second half would even be below the operating margin from last year. None of that is a guess from my side. This was all in the numbers from the release of last week. Which leaves one question worth asking. What exactly was in the first half that isn't coming back in the second? It's defense. A year ago, that division had an operating margin of 15.4%. This half, it was 21%. Their power system segment went from 15.3% to 20.3%. That's an increase of 5 points in just 6 months. And civil aerospace, which is the engine aftermarket, the biggest segment of Rolls-Royce and probably the reason most people own the stock, went from 24.9% to 25.3%. So the civil aerospace division is still the most important one with the highest revenue, the highest profit and the highest operating margin. Defense and power systems together are just over $1 billion in profits between them. Now, to be fair, civil's profit also grew by 31% organically, so that division isn't stalling. But we also see here that it grew in volume. More shop visits, more engine deliveries and more engine flying hours. But it barely grew in margins. And of the two that did grow in margins, Erjan Bilic mentioned one of them himself in the earnings call. He said that the 21% in defense was boosted by a favorable mix of aftermarket work over new engines, and in his words, investors can expect higher margins than they used to have, but not at the 21% level. So the biggest margin increase is not sustainable. And even the 25.3% in civil aerospace, the segment that is holding up the £125 billion company, is also not sustainable. Because £497 million of civil aerospace profits this half came from one line in the accounts. It's called contractual margin improvements, and you need to understand this line because the whole growth story depends on it. Rolls-Royce doesn't really make money selling you an engine. It makes money on the 12 plus years of maintenance that follow. Under the long-term service agreement, or LTSAs, which the airline pays per hour flown, Rolls-Royce keeps the engine running. But to book profits on a contract like that, the company has to estimate today what it will cost to maintain the engine for the next decade and more. Now, when that estimate gets better, because engines stay on wing longer or shop visits are costing less than expected, the accounting doesn't let you spread the good news forward. You have to recognize it immediately across every year of the contract that has already elapsed. So you have years of improvement, but they are all booked in one 6-month period. And that's the catch-up. In the first half of last year, catch-ups were £107 million. This half, it was £372 million. When you add the second piece, which is £125 million release from provisions that were set aside for contracts that were expected to lose money and now aren't, you get the £497 million, against £288 a year ago. And with civil aerospace making £1.5 billion in profits, that single line alone was nearly a third of the profit of the whole division and close to 20% of the entire company's profit. This in itself wouldn't be a problem. But in their own release, they mention that they expect a lower contribution from contractual margin improvements in civil aerospace in the second half of the year. The cash side is worth a look too, because airlines pay Rolls-Royce as engines fly, not as service or maintenance is performed. And that money sits on the balance sheet as a liability until the company has actually earned it through providing their services. Recognizing these profits is what moves money out of that pile. And in the first half of the year, the balance grew by $472 million. This half is only 86. So more engines are flying, more cash is coming in, and the pile of profits that still needs to be realized has stopped growing. Some of that is indeed shop visits. The company is doing more of them, and that's real work being paid for. But the catch-ups are pulling from the same pot, and $372 million is a lot to pull. Which raises the question, is this just an accounting effect, or has the company really gotten better at doing what it does? But before we answer this, If you like the analysis so far and are getting something out of it, hit subscribe. I post up to 2 of these analyses every single week. And if you already hold Rolls-Royce, I would like to know your thoughts in the comments. Do you think this is an accounting effect, or has Rolls-Royce really gotten better at doing what it does? The CEO, Erdem Bilgic, was asked this directly in the earnings call. His answer? The catch-ups are real business improvements from stabilizing the system, and the level won't be as high in the second half, but they will keep coming. And the underlying performance improvement is sustainable. And he can even point at what actually changed. Engines have a higher on-wing time. The lease engine fleet runs harder, and business aviation customers are moving up onto higher tier service contracts with higher margins. And those are exactly the reasons the 20-year cost estimates moved in the first place. Because if your maintenance costs fall, the accounting is supposed to catch up. But there is also a strong objection to everything I just showed you. The second half of the year has had lower margins than the first in the last 2 years too. Last year, the operating margin went from 21.9% in the first half to 20.5% in the second. The year before, 18.6% down to 12.5%. A softer second half isn't a warning sign at Rolls-Royce. It's the regular shape of the business. So the direction isn't the story, the size is. Last year's step down was 1.5 points. This year's step down is more in the range of 5% as we calculated earlier. And for the first time, the absolute profits fall with it. And that's not all. The cash conversion has also gotten worse. This year, they produced 1.96 billion in free cash flow from an operating profit of 2.5 billion. That's a cash conversion of 70.5%. Last year, they got 1.58 billion free cash flow from 1.73 billion in operating profits. A conversion of 91%. So the cash conversion is nearly 15% worse than it was last year. This was caused by 2 things. Higher supply chain costs and a climbing tax for the current year as the old tax losses run out. So when we combine all of this, the conclusion is that this is a business that is actually getting better, but guiding to a second half for reasons that the management already explained. But that was never really the question. The question is what you are asked to pay for it and if it's still a good investment. And as of this recording, you are paying 22.7 times the enterprise value in EBITDA, 35 times the earnings, or 30 times the free cash flow on a forward-looking base. And as you can see with the dotted lines here, that's in all cases around 50% above the averages from the last 4 years. Now, that valuation isn't automatically wrong because their peers are up there too. Safran trades at 70.3 EV to EBITDA, RTX at 19. All above their historical averages. And the PE picture looks pretty similar. On that measure, Rolls-Royce is priced right where a good aerospace business should be. But this only helps if the whole sector is priced correctly. My own rating model splits it about as cleanly as it can. Momentum scores 9 and 8 out of 10, so the stock has done everything right in the last year. But then you get to the valuation inputs. EV to EBITDA, 1 out of 10. Price to earnings at 45 times, 1 out of 10. And by the way, here I measure the trailing metrics, not the forward-looking ones that we just looked at. So the same company in the same model gets a quality score of 7.4, but only a 1 in valuation. A 1 out of 10 isn't a verdict though, it's a question. What would you have to believe about the growth of Rolls-Royce to pay 22 times the enterprise value for this? 17 analysts have answered that question, and the average answer is 16.73. The stock is trading roughly 50.64. So by the street's own numbers, Rolls-Royce is worth about what it costs. There is barely any upside left, and that's the bullish view. My DCF model says something lower. Quite a lot lower actually. And rather than just tell you that, I would like to show you why we disagree, because that's the part that you can judge by yourself. It's for 3 reasons. First, a price target usually isn't intrinsic value. It's a peer multiple. So when Safran trades at around 70.3 EV to EBITDA, Rolls-Royce gets valued at around 22 times and called fair. Second, that consensus is already a bit stale. It blends targets written before these results with one written after. Bank of America, for example, moved from 14.40 to 16.50. Bernstein went from 1150 to 1500. And third, the one that matters most, almost the entire difference comes down to a single assumption about the distant future. Now, one note on the DCF model before we go over the numbers, because it confused me at first. I am using the free cash flow Rolls-Royce reports and guides to himself in pounds. I am not using the figures from third-party websites, because the one I first pulled was in dollars, and even when considering the exchange rate, it was still slightly different from the company's own numbers. So I assumed a free cash flow of 3.9 billion, which is the midpoint of the company's guidance for this year, a short-term growth rate of 14% for 5 years, and a terminal growth rate of 3%. All that with a WACC of 10.2%. With those inputs, Rolls-Royce fair value comes out at 10.90. Against the current price, that's a discount of around 30%. Now, you should be skeptical of any DCF, including mine, because a small change in input assumptions can lead to a vastly different target price. So let's flip it around. Instead of asking what the company is worth, let's take today's price and see what growth it requires to be realistic. And with the same inputs and today's price, Rolls-Royce needs to grow at 23.4% for the next 5 years to be worth today's price. That's nearly 10 points above my own assumptions. So the question isn't what I think it's worth. It's whether 23.4% growth a year for 5 years is a bet you want to make. This is 6% above the 3-year growth forecast from analysts and even higher than the already elevated growth forecast for this year. And when we look at it the other way around and accept the 3% terminal growth rate, and the current price only works with a discount rate of 7.2%. So essentially the whole difference between my assumptions and the market is that my model implies Rolls-Royce enterprise value at 14.4 times the free cash flow. But the market is paying 28.4 times, while the average of the last 10 years sits at 18.3 times. But this average also includes a huge outlier in 2022. Now, 14 versus 28 is a big gap. But that gap doesn't automatically mean that the market is wrong. It might mean that my long-term growth assumption is too cautious. Or it might mean that 14% growth a year for the next 5 years is too low. Or it might mean something that my model can't touch at all. Because a discounted cash flow analysis values cash that already exists. And the newest parts of this company don't produce any yet. I am talking about power systems, the division that builds engines for power generation, not for aircrafts. And this took 4.6 billion of orders in just 6 months. That's 1.8 times what it actually delivered. Its backlog is up 42% to 8 billion. And orders for data center power specifically rose more than 50%. And Erdembillig is direct about the direction here. Continuous power, gas engines that run all the time rather than sitting there as backup, is under 10% of the power generation business today. He expects this to grow to 15 to 20% by 2030. And the servicing profits on those engines are far higher than on the diesel units they replace. So you have real orders and real growth in a division that is already profitable. But you have to put it into context. Power Systems made 528 million in profits this half. The whole group made 2.5 billion. So the division carrying the growth story is roughly a fifth of the profit. And the SMR or AMR nuclear reactors, the part that actually excites people, are even further away. Management guides the small modular reactor business to profitability by 2030. Until then, it burns cash, which means that inside my 5-year growth forecast window, it makes the valuation worse, not better. And nuclear construction has a poor track record. Projects like the Hinkley Point C are years late and billions over budget. Many of these projects are never even realized in the first place, so I find it pretty difficult to forecast this with any accuracy at all. This is all with one correction because most coverage misses this. Rolls-Royce is not new to nuclear. It has built and maintained the reactors in Royal Navy submarines for decades. This is a large, funded, contracted business, but it sits inside the defense segment, not in the new ventures or power systems. It has nothing to do with powering data centers, but it produces real revenue today. But this submarine work doesn't make the reactor bed safer. It just makes it feel safer. So, can the price difference between my model and the market be explained by the future business? I think not. That's essentially the premium you pay for a division that is only owning a fifth of the company's profit and a reactor program that is still at least 4 years from being profitable. So I think we have a good company that is priced for a version of the future that the management has already told you isn't coming this or even next year. The turnaround isn't in question. Their operating margins have improved drastically and they went from 9.6 billion of net debt in 2022 to 1.4 billion net cash. So anyone who is still arguing that Rolls-Royce is a broken business stopped reading the filings in 2022. But I am not telling you that the margins have peaked forever. I don't know that and neither does anyone else. And the current management team has beaten its own guidance for 4 years running and may well do it again. What I am saying is essentially what the company said. The second half will be less than the first half. I just did the subtraction. And at the current price, there is no room for the normalization of the margins or the operating profit that the management has already flagged. So for me, it's a pass. The price where it gets interesting to me is the one my model already gave you, and it's below £11. Now, my next video will be about Eaton, because while Nvidia gets the headlines about the AI build-out, someone has to deliver the electrical infrastructure it runs on. And that order book tells a completely different story of who actually is capturing the money. So if you don't want to miss it, hit subscribe. And if you would like to know why everyone is looking at IBM the wrong way and what the actual fundamentals are that matter, watch this video next. And of course, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys and see you in the next video.